Welcome back, friend. Kris Krohn here, and we are right in the middle of this journey of sharing with you the very best markets to be in. And I thought for today, what would be the most useful thing is if I bring Tyler back in, my acquisitions director, and we actually show you live deals, pro formas, actual deals that are going down right now. When I talk and brag about doing 4,000 homes and how amazing they are and our amazing ROIs in the last 5 years, the $70 million we've made for our investors, let's actually show you the hot deals that make that happen, because we're literally doing them just about every single day, and you could be getting in on the action. So check this out. All right, check it out, friends. I got Tyler Bennett back here again, and we are going to start by showing you a property in our growth market. This is a house on Emily Boulevard. This is in, if you watched the last video, this is in Orlando. This is right now the #1 growth market in all the United States. And so what we're going to do is I'm going to have Tyler share with you this pro forma. And as you look at it, do not allow your eyes to glaze over like, oh my gosh, like, what are you trying to do? Hypnotize me with boringness? I'm going to die from lack of understanding. Check it out. We're going to walk you through this. If you want to be a sophisticated investor that is earning these high ROIs, we're going to show you how to read this right now. So tune in. You're going to probably watch this video a couple of times. So yeah. Tyler, what are we looking at here?
So now I get to have some fun, Kris. This is the stuff that I enjoy. So we're just going to dive into, just so you can kind of understand the context of this, is we have different suppliers, agents, everybody sending us houses in the market.
Yep.
They send them to us and we underwrite every single house and either stamp it with approval or we toss it out because it doesn't work. This is what we start with. So we put it all into these pro formas and we want to make sure it's going to perform how we want it to perform. So I'm going to go through one of those pro formas.
Yeah, and something that you need to understand is that when we actually find a really good deal, we actually don't know if we're going to get it yet. You know, half the time our offers, they bounce and we just don't get them because we got outbid. Because remember, we are super aggressive on getting our high ROIs. We got super strict criteria. And so if you are one of my partners watching this, it is important. I want to recall your mind to one of the previous partnering videos where we talked about that when we find a hot deal, you might want to dive in and be like, oh my gosh, this is amazing. Let's look at the numbers. And I'm like, we don't really care yet. Just sign the dang document that's in your email because we don't even know if we're going to get it. If we're going to get it, because after we get it, we got to get the rehabbers in there. We've got to get we got to actually firm up our rent numbers from our property manager, and it'll take a few days to solidify the numbers, and then we'll know, these are the real numbers. But we got to start with something that says, I think we're sitting on a pile of gold here, and that's what Tyler's going to take you through right now.
Good. All right. So let's look at this, Kris. So one, we start off with just obviously a little picture of the house so you can see what it is. But I'm going to start right here on the top left. So $168,000. So we start with purchase price. What can we get this house for? And then we have down payment, we have closing costs, rehab expenses, and acquisition fee, all right here in this top column.
So if we take all of these and add up all of those together, that says our total property investment, or what we sometimes call our TOP, our total out of pocket, for this property is
$47,815.
All right. So now, if you remember, in a cash flow market, sometimes it's a $20,000 to $35,000 down payment, and in a growth market, this is kind of more the typical. It's usually going to be between $40,000 and $50,000 to get in on a property that has high appreciation, high growth, awesome cash flow, etc.
Yep, correct. And this is the number we're going to use to base all of the returns off of, because we want to base it off of total investment. A lot of people err and just think, oh, what's my down payment for the mortgage? And they calculate an investment off of that, and it looks way better than it really is.
Well, and I noticed that right underneath that, you also have property management set up. That's actually just a placeholder. Property management in this market is how much roughly?
It's 6%. Yeah, it's awesome. Yeah, and what that is we want to make sure that it doesn't only have $48,000 and that's all they have for this property, because the average days on market might be 21 days to get this rented. Well, that means it could take 40 or it could take 5.
Right.
And if it's a 41, they might have to make a mortgage payment, or sometimes we don't put fridges in the properties because tenants bring them. But 10% of the time they don't, and if the tenant is really good or will sign a long-term contract, we may need to put a fridge in. And so that's just a contingency.
All right, so you got a little buffer there. And then underneath that, check this out, friends, 2005, right?
Yeah, so this was built during the boom, right? In a little new community that was going up during that boom. 1,600 square feet, 3-bed, 2-bath. So our 2-car garage. So just our typical fits inside of our box.
And just notice right there that what Tyler did is he referenced the box. And we have a very, very tight, narrow box. And a lot of people in real estate are always trying to make money by going outside the box. Yeah. But when you go outside of the box, and the next time you go outside of the box different, and the next time you go outside of the box different, then you're collecting experience in 3 different strategies. And the reality is the reason why we have such predictable, amazing results is because our box always says the properties always look the same, they act the same, they squawk the same, they talk the same. And that gives us predictability in what's called actuaries. It means that we can look at a zip code on our last 100 purchases and then find out what might vacancies look like in that particular area. Now we're bringing a level of sophistication and intelligence that a real investor really wants to have access to.
And I wish we could say that we've been doing this all along, but we've learned as we've gone.
Yeah.
And when we first started, sometimes you have deals coming all over, and sometimes it was, how do we make this deal work? And when we took that perspective, it just, in the long run, it wasn't the winning formula. Yeah. And so now we really do work in this box, and we're never, how do we make this work if it's outside of our box? It's in it or it's not.
Yeah.
Yep.
Okay, what else are we looking at here?
Okay, so monthly rent. So this one will rent for $1,375, and then you have a typical 20% down payment mortgage on this, and so the principal and interest will be $773. We have taxes, and then we have insurance, and so your total mortgage payment is $1,036 a month for this house.
Okay, so it's $1,036 to cover everything, and we're expecting about $1,375 rent.
Let me show you how that translates now to, well, what's the cash flow?
Right.
And what else is there? I do want to reference these assumptions, though, because this is important. So obviously we talked about the 20% down payment. We're estimating 4% in closing costs, interest rate of 5.625%. Which is a typical investor interest rate right now. It's about 1% above a primary mortgage.
Now, what the freak is going on here, dude? You're showing freaking 6% property management. Everyone knows property management costs 10%.
10 or 12%.
What's happening?
Yeah, this is just economies of scale. We do a lot of business with those property managers in that market, and we're able to pass that savings on to our clients.
You need to understand something, that the only way that you win at the highest level in real estate, yes, it is being in the best market, but then you win always by bulk. It's a volume game. When you actually go out here and you take a look at the potential, repairs that this might need, the rehab of $3,500, we're not just hiring Joe the Yahoo,
guy from Google. Yeah.
What we're doing is we have crews that go from one project to the next project, and the next project. And when you create that dependability, guess what happens in price? It goes down. Yep. Guess what happens when you're doing your carpet for that particular area in your tile? It goes down. You actually have the ability to start doing rehab in bulk. And this is where you start getting super intelligent prices. Well, you know what colors to paint things. It's a system. It's ones and zeros. It's the matrix. We know everything about everything for the system.
And we can hire people and bring them in-house and have them as full-time employees instead of just contractors. And then it gets cheaper. And so many, many areas where we reduce costs, which increase performance, obviously.
So just understand in this area, to get a 6% on the property management, that's insane. Many of our markets are still 8%, which is still below the 10 to 12%.
Correct.
But that's what happens when you deal in bulk, is that you start saving money everywhere.
So a couple more assumptions here. So we have vacancy and repairs at 8%. And Kris, we track all of this. So I know exactly how many 12-month leases last year renewed and what percentage didn't. And if they didn't renew, how many days on market and what repairs or rehab they had to do to make it rent ready to find a new person. We track all of these numbers to put into our assumptions. And this is a newer house. If this house was maybe 10 years older, that would be higher, for example. And even newer houses, it might be a little bit lower. And so we customize that assumption based on every single house. And then we assume a few things here, and this is appreciation. So we talked before that Orlando's projected to have about 30% appreciation over the next 3 years. We put 8% in here, so we're basing our numbers off of 24%. So we're trying to be conservative. And then after those 3 years, we bump it down to just a normal 4% type appreciation, because it's tough to forecast out much further than 3 years.
Listen up, guys. 2008 hits. We start stepping into the best markets, Phoenix, Vegas, other markets. And my real estate was growing at over 30% a year on a breeze. And part of the reason why I was doing that is because we had all of the numbers. My performance on my properties, however, were significantly better than what was projected. And that really just comes from a philosophy that says, this is, after all, a pro forma. It is not a crystal ball that says exactly what will happen in the future. So we're always going to err on the side of being conservative and having contingency plans.
So we have these assumptions, and then that comes down to this basically profit and loss statement of income expenses on a year-by-year basis. So if we were to simply just look at year one, we would see, right, the rent of $1,375 times 12 is $16,500. You've got your annual taxes, your insurance, HOA, property management. We're assuming no vacancy repairs year 1 because we're assuming this starts when we place a tenant.
Yeah.
And then, of course, at tenant turnover is when we kind of start that assumption and allocate towards that. So you have your net operating income, then you have your total mortgage payments, and then you have the difference.
Yes.
Right? So the difference between those two is at 341. Now, this is on a monthly basis, which if you annualize that ends up being an 8.57% return. And then after that, you would potentially have your vacancy and repairs, and that's where that 5.81% comes in.
So right now, let me just help you understand what Tyler just did. There's several ROIs when evaluating a property. Right now, what he's referencing is the cash-on-cash ROI.
Yep.
It basically means if I put an X, what am I getting back? Now, this is not a cash flow market. We're not putting $47,000 down because we're looking for tons of cash flow. And I want you to understand that what Tyler's doing is he's showing you the real cash flow instead of the gross cash flow. A lot of times people get excited on the gross cash flow versus, yeah, but let's just say in year 4 that we're going to have to repaint and carpet. How do we factor that into the cash flow today? We do that. It makes our numbers look worse, but the reality is I've been investing in real estate for over 15 years, and at the end of the day, I want to deal in the world of reality and nothing different.
Yep.
So I love the way that we put these numbers together. They're all designed. And Tyler, I want you to finish going through this, but then I want to get them at the end. We're going to actually show you the exciting numbers on this, which is what is my real total ROI? We're saving it for the end. So hang tight.
Okay, good. Let me just skip to year 10, Kris, because this just outlines, right, years 1 through 10.
Yep.
And we're still just talking about cash flow.
Yep.
We're not talking about principal pay down. We're not talking about tax benefits, appreciation, none of that yet. So this is still just cash flow.
We're in the far right column over here right now.
Yep, right here in year 10. So why is rent so much higher? And it's because we're assuming annual rent increases.
Yeah, it's always going to happen.
Correct.
And it's our job to make sure that they happen, or else this is how novice investors, hurt themselves all the time. This is professionals stepping in, making sure that this happens every year.
Yeah, and it's one of the advantages to hiring a property management company. That is their business. I've self-managed some of my own personal properties, and my heart gets in the way. And truthfully, I'll analyze a house. It's like, God, they're paying $300 less than they should a month, and I'm paying them $3,600 a year to live in my house.
Yep.
But it's because I let my emotions get in the way, and so let professionals do it, outsource it.
So even the guy that's facilitate 4,000 deals still has his heart getting in the way.
Right. But yeah, so we're increasing it every year.
Yeah.
And if you just look to the bottom here, now we're cash flowing $600 a month, $650 a month.
After everything.
Correct. This is after everything. And now you're making a 16% cash on cash ROI. And that's just simply taking that 661 number, timesing it by 12, dividing it by that investment of 47,000. And I mean, those are phenomenal numbers.
Yeah, absolutely.
And a lot of times people can't see to year 10.
Yeah.
They just look at year 1, and the power of time is huge in any investment, and particularly in real estate.
You got to understand that how you win is with the game of compound interest. And if you're going to hold this property for 10 years, long before we've harvested some of that money out through a refinance, or we've sold it potentially and traded it for a couple of more, so all of a sudden those ROIs, they start stacking really fast because the original dollar is now sitting in multiple investments and growing a ton, which of course, don't look at real estate in terms of 5 years. Don't look at it in terms of decades. You got to look at it in terms of lifetimes. Because we always underestimate what we can do in a decade, but we always overestimate what we can do in a year. And if you stay long-term in this game, some of you are like, but Kris, I want to be financially free in 5 or 10 years. Good. But you should still hold your real estate 20 years after that and 30 years after that, because you can't even begin to imagine what that explodes into when it comes to leaving a legacy and really leaving some powerful good on this planet for people.
Yeah, absolutely. So now let's look at the real fun part about real estate. So if you look down in this second section, you'll see this principal reduction right here. Of the first year, 1989.
That's the money that you're paying down.
That your renters are paying down for you, Kris.
That the renters are paying down.
Yeah. So I call it deferred cash flow simply because you're not getting it today, but you're guaranteed to get it tomorrow because your principal is getting paid down. When you sell that property, you're going to get that back.
Okay, so we've got the deferred reductions.
Yep, which equals about a 4 to 5% additional ROI.
That's hot.
Yeah.
All right, awesome. Keep going.
And I'm going to skip to the bottom really quick. We've got this depreciation and tax savings. And I won't go into a ton of detail on this, but suffice it to say, you can depreciate your asset, your house, over a 27.5-year schedule. And so for ease of numbers, if you had a $100,000 house, you're getting a depreciation of about $2,700 per year. of taxable income that's coming off of your taxes. And if you're in a 25 or 30% tax bracket, you're saving $1,000 or $900 or whatever that number is exactly in actual cash today.
What it's actually doing is it's actually taking the real money that you're getting and lowering it on paper so you don't have to pay taxes on it.
Correct.
Which is why everyone needs to be in the game of real estate, and it's mind-boggling that most aren't.
Yeah. And you can defer it over time. When we sell, we do 1031 exchanges and all of that where we can defer and eventually potentially avoid those taxes long term through estate planning and a lot of cool stuff like that.
All right.
So you've got an extra about 7%-ish in cash on cash ROI between principal pay down and depreciation savings or tax savings. And then we add in the appreciation. So if you look at year 2, right, we're assuming 8% on this particular house, which represents, $13,000, and divide that into a $47,000 investment, that's 28% just in the appreciation.
It's huge.
Yeah.
It's really, really, I hope you guys just caught what Tyler just said right there. To get 25% annual ROI on the money that you put in just because of an 11% appreciation on the property. Listen, for some of you, this might be going over your head, and here's what you need to do. Watch it again. Because these are the things that you really want to understand. If we're going to play together or if you're going to play on your own, there are some things you can't outsource, and there's certain things that you cannot afford to to ignore. And this is one of them, is that some people I meet, we meet people that they're like, I don't really not good at math, and we'll always strive to say, understand just these few pieces, because everything that Tyler's sharing with you is addition, subtraction, multiplication, or division. There is no algorithm of, to the power of 10 minus, guys, there's no cosines and coefficients. This is just basic math that we want you to see. It's all plugged in here, and now it's all going to come together into what we call the total projected ROI, which is what you've been waiting for, whether you knew it or not.
So really what it comes down to is you've got this 20 to 30% potential growth in appreciation, but along the way, you're making 10 to 15%. So where a lot of people err is they put too much emphasis on growth. And California, for example, right? A lot of people made a lot of money in real estate, but they got zero cash flow along the way. And if it doesn't grow, then there's a lot of risk associated with it. So we not only have this awesome upside of growth, but we get cash flow along the way, and we make 10 to 15% along the way with upsides of 30 to 40% when you add them all together.
Yeah, beautiful. All right, well, let's get to the bottom line on this deal.
Okay, so at the end of the day, we're going to come back up here, and we're going to look at these averages right here. So I'm going to highlight this area right here.
You want to zone in. This is what you've been waiting for.
And so what you have is you have this 5-year average, 7-year average, 10-year average.
And that's the cash on cash.
Yes.
Meaning, if I put this money in, what liquid cash should I be returned into my hand? Not the total ROI, not the appreciation and growth that you get to capitalize on when you sell or refinance, just the cash flow portion.
Yep.
And you're looking at
6 to 10%.
Yep.
Net. Now I do have this number down here on the bottom where you'll see this 8, 10, and 12. And what that is that's your actual cash that'll actually go into your bank account. But I want you to remember, hey, you're going to have a vacancy, you're going to have a repair, so you need to allocate that to go back into the property. But before you do that, it shows what those numbers are.
Now listen, 6 to 10%, I want you to remember something. This is not a cash flow market, but those numbers are outperforming your stock account on average, they're outperforming your 401ks, they're outperforming your IRA. And remember, that's just this part of the real ROI. What's the total ROI on this, Tyler?
So, you're looking at 27 to 30%. And this particular number right here does not include the principal pay down or the tax benefits. So you start adding those in, and there's another 7-8% on top of that.
So guys, you're looking at, with those deferred portions, you're stepping in out of the gate at over 30%. You almost have, you put $1 in and your investment is giving you already a 33% return. Friends, you just need to understand something. Money is a game. Getting rich is a game. Getting wealthy is a game. And if you don't know the rules of the game, you can't win. But when you actually learn the rules, which is what you're doing right now in the game of real estate, then you have the ability to plan a real retirement. Then you can plan real charitable foundations. Then you can look at your social footprint and ask yourself, what's my legacy? What good can I do? These are the kind of returns that elevate you out of the dust of the earth. These are the kind of returns that actually can put you in a position where you've got options, and more importantly, one word that I'm passionate about, freedom. And the freedom that is available to all of us, we're lacking the education and just the discipline to put ourselves into something like this that makes just a world of a difference. So Tyler, as we wrap this up, go ahead and just open up the map, show us where this guy is on the map, just show us the area real quick. And then in our next video, we're going to break down our cash flow market and show you what that looks like.
So real quickly, here's the general Orlando area right here. Disney World's down in this area, and we focus all down here. So kind of south and southwest in Orlando. This particular house is right here in Winter Haven, which is this little awesome community. It's growing like crazy. You have a ton of redevelopment, new development, and so that's where this house is. I'm gonna go street view really quick just because I think this is fun, because I like to see a tour of the neighborhood.
And while you're picking that up, I just want to share that I've got, we just picked up a house, I think that's 2 miles away from the park.
Mm-hmm.
I mean, guys, that's talk about location, location, location.
If you look at this neighborhood, my internet's still zooming in here. What we want to make sure, obviously, is that this isn't some house that's sticking out one way or another in a neighborhood. We don't want it to be the smallest, oldest house, or we don't want it to be the biggest, nicest house.
We just want it to be nice.
What does the neighborhood look like? And so this just kind of shows you what the neighborhood is, and we can go in and do tours of it. But most of the houses all look the same, and we're going to fit in great.
So Tyler, just some final questions for you. If this house looks amazing, and then we go in and put an offer on it, this is just the beginning of the process. We've got to get video footage, picture footage. There's all sorts of crazy amounts of due diligence.
We send in our rehab teams, our inspectors, our appraisers. Yeah, we do a lot of work before we actually close, because again, these are projections and we want to fine tune them as much as possible. And you mentioned earlier that it's just addition, subtraction, and easy math, but the hard part to it is getting the accurate numbers in. Right. So it's spitting out the sum that's going to be as close to the actuals as possible.
So I want you to understand something. What we have just shared with you in this video, and thanks for hanging tight and watching it, we've just been laying down a typical average deal that is probably the best deal you may have ever seen in your life, or that the average investor will ever come even close to. And this is what we do all day long. And friend, I'm telling you something, that when you understand the rules of the wealthy and you have your money starting to compound at 25, 30, and 35%, and over time even more, then the moment we sell this property and buy 2 more, now we're making 60 to 70% on our money. Then you sell it again, you buy 4 more with it, your original dollars are earning you over 100% a year on your money. And I'm at the point where I've been doing this for 15 years. So I'm at the point where some of my dollars are, kid you not, are earning thousands upon thousands of percent every single year for me. And that's what the wealthy are doing. We're showing you right now exactly what it looks like. And if you're sitting there thinking, man, I wonder if it would make sense for me to really look at partnering with Kris and this team and accessing these deals, or what could that even look like? What you need to do is go into the description below, click the link, and you're going to talk to a member of my team, and they're going to take you through a vetting process. And the reason why we need to vet, we want to vet you, first of all, to make sure that this is a reality, that we can make this happen for you. And I'll be honest, I'm also vetting you for your attitude, your energy, and I just want to know, are you someone that we want to work with? We're at a place in our life where we don't have to do this anymore. We do it because we love it. We do it for the sheer joy, which also means that we love working with people that we love working with. We want our benefactors to be the individuals that are in a grateful space. They'll do their part. They'll show up, because heaven knows we show up and we do our part. So keep that in mind when you're filling that out and talking to a member of my team, because we're not here to work with any jerks or or individuals like that. We want to just have fun building wealth with the right people, and that might be you. Where we're headed next, we've just shown you our growth market. We're going to be diving in on one of our cash flow markets. We're going to show you what those numbers look like. If this stuff excited you, this cash flow stuff is really going to get you super up in the night, super excited. And so click the link if you want to, start working with us right now, or join us on the very next video, and we'll break down those cash flow deals for you.